Thank you for joining us today. Right now we will be discussing a financial analysis of aerospace firms. We'll be looking at Lockheed Martin, Raytheon, Northrop Grumman, General Dynamics, and Boeing. For each we'll be examining their short-term solvency, long-term solvency, return on equity, and market position. So let's get started. First, we have Lockheed Martin, which is a global security company, a leading global military contractor whose businesses span four main segments: aeronautics, space system, missile and fire control, and rotary and mission systems. Looking at their short-term solvency, we see that their current ratio has been declining since 2017. It has been on the rise over the past year and is currently above the 5-year average at 1.27. So the firm has $1.27 in current assets for every dollar in liabilities. The firm's cash ratio has followed a very similar trend as the current ratio and currently sits at 0.17. So for every dollar in current liabilities, the firm has 17 cents in cash. While these numbers are lower than some of Lockheed Martin's competitors, they are not out of the ordinary for the aerospace industry. So while the firm does not have much room for error in its net working capital, the outlook for its short-term solvency is not overly grave. Turning our eyes to long-term solvency, we see it's a bit concerning at first glance. The firm's debt-to-equity ratio and financial leverage have seen some drastic increases over the past 5 years. This is largely due to large increase in debt in 2015, which helped to finance the purchase of Black Hawk helicopter manufacturer Sikorsky for $9 billion. Despite these increases, the firm's total debt ratio has stayed stable over the past few years, showing that the portion of assets financed by debt as opposed to equity has not increased drastically. Most importantly, though, Lockheed Martin is able to afford its increasing debt. The firm's EBITDA to interest expense is currently 12.93, which is equal to its 5 years average. So for every dollar in interest expense the firm has, it has $12.93 in earnings before interest, taxes, depreciation, and amortization. This, along with the fact that the purchase of Sikorsky has Bloomberg projecting an increase in EBITDA over the next 2 years, shows that Lockheed should not face too many issues covering their long-term debt obligations. Looking at return on equity and market position, we see Lockheed Martin has a rather interesting one. From 2014 to 2016, the firm's return on equity increased by 165%. But for the past 2 years, the firm has actually had negative equity. This surge in liabilities that caused equity to go negative can be traced to two items on the balance sheet. First, the long-term debt Lockheed took on to pay for Sikorsky, as well as two large increases in pension expense in 2016 and 2017, both equaling around $2 billion. Despite this surge in liabilities, the market still has confidence in Lockheed. The stock price has been steadily increasing for the past 5 years, and the price-earnings ratio, while lower than many in the industry, has stayed steady. Moreover, looking at the price-to-book ratio, we see it's been rising, showing that the market values the firm more than its historic cost. This, paired with the expected increase in profits over the next 2 years, shows that Lockheed Martin is in a relatively firm position despite increases in liabilities and negative equity. Now let's turn to Raytheon. Raytheon is a technology company specializing in defense and homeland security. It's known as being the #1 missile maker in the world, which is why it's one of the Pentagon's top 10 contractors. Its business spans 5 main segments: integrated defense systems, IT, missile systems, space and airborne systems, and force point. Looking at their short-term solvency, we see that their cash ratio has declined by about 50% over the past 5 years, from 0.82 in 2014 to 0.41 in the current period. This means that their ability to cover their current liabilities has declined from 0.82 to 0.41 in cash for every $1 in current liabilities. That being said, the firm's cash ratio is still well above the industry average. Raytheon's current ratio is currently sitting at 1.62 and has been relatively stable over the past 5 years, with only minor fluctuations within the range of 1.5 and 1.8. This too puts the firm above industry average. Looking at these two ratios, one can see that Raytheon is in a very firm short-term solvency position. Now, if we change our view to long term, we see that Raytheon's financial leverage has stayed relatively consistent over the past 5 years. sitting around 3, meaning that they have about 3 times as much assets as they do equity. This can also be read as their debt is about 2 times their average total common equity. When we look at their total equity, rather than the common equity used in financial leverage, we see that Raytheon's debt burden as a proportion of equity shrinks even more. This can be seen in the total debt to total equity ratio. Here we can see that the firm's total debt is about 47% of total equity, meaning that for every dollar in equity Raytheon has, it has 47 cents in debt. The brightest point for Raytheon, though, is for its long-term solvency, is its growing EBITDA to interest expense ratio. Over the past 5 years, the ratio has increased by 47% to 25.02. This shows that for every $1 in interest payment, Raytheon has $25.02 in earnings before interest, taxes, depreciation, and amortization. This tells you that Raytheon is more than capable of paying for its long-term debt. Moving on to look at ROE and market position, we see that Raytheon's return on equity has stayed fairly stable, but it has been below the 5-year average since last year. This dip is mainly due to the firm's falling profit margin, which has also been below average for the past 2 years. Despite this, the market has a great deal of confidence in Raytheon. The firm's price-earnings ratio has risen steadily for over the past 5 years and is currently sitting at 24.91. This means that Raytheon's stock price is 24.91 times the average earnings per share. This tells investors that the market is confident in Raytheon's future cash flows and their growth. Now, the price-to-book ratio, while not exceptional when compared to others in the firm or other firms in aerospace, it is increasing. This growth is coming from a rise in the firm's stock price, not a decline in the book value per share, meaning that the market believes that Raytheon's future cash flows will increase even if their current earnings per share are stagnant. Turning to look at Northrop Grumman, it is the third largest military contractor behind Lockheed Martin and Boeing, and its business spans 3 sectors: aerospace, mission systems, and technology services. The firm recently purchased Orbital, which makes them the 3rd largest supplier to NASA and expands their aerospace capabilities. Looking at their short-term solvency, we see that in the past 2 years, their current and cash ratios have jumped well above the rest of the industry. From 2014 to 2016, these ratios were fairly steady. But in 2017, the current ratio almost doubled to 2.35, and the cash ratio quadrupled to 1.61. This jump can be attributed to the large loan that Northrop Grumman took out to purchase Orbital for $7.8 billion in cash. The purchase was recently approved by the government, but the cash outflow has yet to appear on the financial statements. Using Northrop Grumman and Orbital's financial data, one can estimate the inflow and outflow of cash and assets from the deal. Using these estimates, you can calculate the firm's post-acquisition current ratio and cash ratio to be around 1.64 and 0.4 respectively. Despite this drop in ratios, Northrop Grumman still is in a very firm short-term solvency position when compared to other firms in the aerospace industry. Turning to the long-term view, Northrop Grumman's long-term solvency leaves some to be desired. Every measure of debt has been trending upward for the past 5 years. The firm's total debt doubled in 2017 as it gathered the $7.8 billion needed to purchase Orbital. This led to the firm's total debt ratio to increase by 16.12 points. This should decrease once Orbital assets hit the balance sheet, but $1.4 billion in Orbital's debt will also be consumed as part of the deal. While these debt measures are trending upwards, they are still far smaller than the likes of Boeing and Lockheed Martin. That being said, Northrop Grumman does not have Boeing's ability to pay for debt. Northrop Grumman's cash coverage ratio has been declining over the past 5 years and currently sits at 6.83. While the purchase of Orbital does look promising for the firm's future cash flows, there remains reasonable concern that their ability to repay a 5-year loan will shrink. A major loan would increase the EBITDA to interest expense, presumably, and this would leave a very small margin of error for the firm to cover its interest expenses. This, paired with the risk of a potential financial stresses of a rocky acquisition, makes Northrop Grumman a weak candidate for a long-term loan when compared to other firms in the industry. Looking at the return on equity and market's position, we see that the market has a great deal of confidence in Northrop Grumman's future cash flows. The firm has a strong price-to-earnings ratio, which has been increasing for the past 5 years. This increase is largely due to the stock price, not the firm's earnings. Northrop Grumman's stock price has increased by 120% over the past 5 years, but the earnings per share has only increased by 22% during the same period, showing more confidence in future cash flows than current earnings growth. The largest increase in stock price occurred in the last 2 years. During this period, the price increased by almost $100 per share. This was when Northrop Grumman started to publicly pursue Orbital, which implies that the market has great confidence in the prospects of the acquisition. Northrop Grumman's price-to-book ratio has declined slightly over the past 3 years, but it is still above its 5-year average, sitting at 7.26 compared to 6.57. These numbers show a relatively high level of market confidence for Northrop Grumman. This is despite its relatively flat return on equity. The firm's current ROE of 31.94 is almost identical to its 5-year average of 31.976. That being said, Bloomberg is projecting major increases in ROE over the next 2 years, so the market seems to be confident that the Orbital acquisition will be of major benefit to the firm's future cash flows. Now we turn to General Dynamics, which is a diversified defense company that serves both governmental and civilian clients. Its business sectors span IT, marine, combat, and aerospace systems, and the recent purchase of CSRA will expand General Dynamics' IT sector. Looking at their short-term solvency, we see they are in a fairly secure position. The current and cash ratios presently sit at 1.34 and 0.28, which is slightly above the 5-year average of 1.282 and 0.24. While these numbers do not give General Dynamics much room for error when it comes to managing their net working capital, they are in a solid mid-range position when compared to others in the industry. So with the firm's current liabilities and current assets where they are, General Dynamics would not be too risky when it comes to a short-term loan. Taking the long-term view, we see that General Dynamics debt measures have remained quite stable from 2014 to 2017 at rates below industry average. But we see the debt-to-equity ratio and the debt-to-asset ratio jump up in 2018. This increase is caused by a 63% rise in the firm's debt. Interestingly, though, this increase is almost entirely in short-term debt, which increased from $2 million in 2017 to $2.498 billion in 2018. This increase in short-term debt would presumably cause General Dynamics' EBITDA to interest expense to decline, but the cash coverage ratio for the last 12 months is not available, so it's difficult to say for certain. But the short-term nature of this debt increase, paired with the increased cash flows from IT contracts, which the recent acquisition offers, leads me to believe that we will see General Dynamics' ability to pay for its debt rise over the coming years. And with the 5-year average of General Dynamics' EBITDA to interest expense leading the industry, General Dynamics would be a low-risk recipient of a long-term loan. Looking at return on equity and market position, the firm's ROE has been trending upward, and a good portion of this trend is due to increasing return on assets, not just an increase in financial leverage. Moreover, the firm's return on equity has been consistently above its 5-year average, and Bloomberg is projecting it to increase over the next 2 years. Looking at the market measures, General Dynamics' price-to-earning ratio and price-to-book ratio have been trending upward over the past 5 years as well. While these numbers may have dropped in the last year, they are still sitting above their 5-year average. But Bloomberg is projecting both ratios to drop over the next 2 years. This leads me to believe that the market is not very confident in General Dynamics' purchase of CASR. Now we turn to our final company, Boeing. Boeing is most known for its commercial aircraft contracts, but it also works with governmental defense. It has 3 main business sectors: commercial planes, defense, space and security, and Boeing Global Services. BGS was recently started in 2017 and expands the firm's offering into supply chain management, engineering, aircraft modification, digital analytics and training, and professional services. Looking at Boeing's short-term solvency, it is the weakest in the industry. Their current and cash ratios have been declining for the past 5 years. Boeing can still cover its current liabilities with its current assets, but there is not much wiggle room. Currently, the firm only has 15 cents more in current assets than it does in current liabilities per dollar. And for every dollar in current liabilities, they only have 13 cents in cash. While I don't think Boeing is going anywhere anytime soon, their low net working capital is concerning, and they would be a risky recipient for a short-term loan. Turning to the long-term solvency, we see that Boeing has some of the highest debt in the industry. Its financial leverage jumped up significantly over the past 2 years, sitting currently at 130, which means that for every dollar in equity, the firm has $129 in debt. The firm's debt-to-equity ratio has been also declining for the past 3 years, but its debt is still 9.5 times the amount of their total equity. That being said, these changes seem to be more due to fluctuations in total equity levels, which is evidenced by the stability of total asset ratio. The firm's total equity has experienced some drastic fluctuations over the past 2 years, but their total assets and total debt has remained relatively stable, which is evidenced by the stability of the total asset ratio. Despite Boeing's large amount of debt and its high debt measures, the firm is in a strong long-term solvency position because they can easily afford this debt. Boeing has the second highest EBITDA to interest ratio in the industry. It currently sits at 33.1, which is above its 5-year average. And with the projected increase in EBITDA over the next 2 years, Boeing should have no problem whatsoever taking on more long-term debt. Looking at Boeing's return on equity and market position, at first glance, their ROE makes it look like a sure buy. The firm's ROE has been close to 1,400 for the past 2 years, making a major jump from 136.88 in 2016 to almost 1,400 in 2017. But while the size of these numbers are impressive, this jump in ROE is almost entirely due to the large increase in financial leverage that the firm experienced in 2016, an increase of over 6 times from 25.78 to 155.57. The firm's ROA has been trending upward due to the increase in profit margin, but these increases are nothing compared to the increase in financial leverage. Despite this increase in financial leverage, the market still has great confidence in Boeing. The firm's price-to-earning ratio has increased by 52.2% over the past 5 years, showing a growing market confidence. Over the same period, Boeing's price-to-book ratio has increased by 1,494%, showing that the value of the firm on the market is growing in comparison to its historic costs. Now let's move on to my picks. For the short-term loan, my number one pick has to go to Raytheon. It has the highest current and cash ratio in the industry, and its numbers have stayed relatively stable over the past 5 years, which shows a strong net working capital management, which is important for short-term loans. Now second, and it's a close second, is Northrop Grumman. As I showed in the presentation, Northrop Grumman currently has very high current and cash ratios, but once the orbital purchase hits the books, those ratios should drop down closer to Raytheon's level. I chose Raytheon over Northrop Grumman due to the fact that there is always a little bit of risk involved when it comes to an acquisition, especially of the size of the orbital purchase. So that, while I'm sure they'll do fine, it's still a little bit riskier than Raytheon's stable, high current and cash ratios. Looking at the long-term loan, I have to go with General Dynamics. They have the lowest financial leverage, so they don't have much debt to begin with. But on top of that, they have the highest EBITDA to interest expense. So they have very, very easy ability to pay for any increase in interest that they have. Second is going to be Boeing. Like I said, Boeing does have the highest level of debt in the industry. But if you look at their EBITDA to interest expense, it's right behind General Dynamics. So even if they have high levels of debt, they have no problem paying for it. And additionally, the market seems to be very confident in their future earnings, which again leads me to think that they'll have no problem paying for future debt increases. Now when it comes to purchasing equity, I'll start with my second choice, Northrop Grumman. It has one of the highest ROEs in the industry. It has low financial leverage compared to others in aerospace, and most of that ROE is actually coming from return on assets, not the financial leverage, which shows good asset management. On top of that, the purchase of Orbital seems to be a great buy for them. It makes them the third largest supplier to NASA, and it also expands their aerospace capabilities. And the market has been responding very positively to their acquisition. This, along with their rising price to earnings ratio and their rising stock price, shows market confidence, and I think they would be a fantastic purchase of equity. But my number one pick has to go to Boeing. Boeing's ROE is extremely high. Part of this is, of course, like I said, due to financial leverage. But if you look at their return on assets, it is the highest in the industry, showing that not all of that return on equity is just coming from financial leverage. On top of that, I see much opportunity for increased cash flows, largely from Boeing's global services. This helps to expand their ROA even more because the Boeing Global Services will allow for a larger parts market as well as a larger support market, both of which have much higher profit margins than the sale of full aircrafts. Moreover, this extends the cash flows from contracts. This can be seen in the Vietjet deal, a major deal that Boeing recently went in with the Vietnamese airline Vietjet. Their deal not only bought a large number of jets from Boeing, it also entered them into a 10-year agreement for support as well as parts. This not only expands the profit margin of the deal, extends the cash flows from the deal further into the future. It also helps to encourage the growth of airlines in Asia, which, as Bloomberg reports, is the largest growth potential for airline industry in the world. This, along with Boeing's high price-to-book ratio and high price-to-earning ratio, some of the highest in the industry, shows strong market confidence in the company, and I think that Boeing is going quite a few places. So for purchasing equity, I think it is the best choice in the aerospace industry. I thank you for your time today, and I hope you learned a bit about the finances of our top 5 aerospace companies. Thank you.